Hey everyone, it's Learn Something New, and let's talk about something that's probably on a lot of our minds lately. The stock market. Specifically, is a crash on the horizon? Now, I'm not a financial advisor, but we're going to dive deep into the factors at play right now and analyze some historical trends. Because let's be real, trying to time the market perfectly is like trying to predict the lottery. The odds aren't really in your favor, but understanding the fundamentals, recognizing potential warning signs, and having a solid plan, that's how you can weather any storm and come out ahead. So, whether you're a seasoned investor or just starting out, stick around, hit that subscribe button, and let's break this down together. All right, let's kick things off by checking the market's temperature. We've been on a bit of a roller coaster ride these past few years, haven't we? We had the massive dip in 2020, followed by an insane bull run. And now things are feeling a little shaky again. The S&P 500, a good indicator of the overall market, is insert current S&P 500 data. Mention if it's up or down significantly. Interest rates are insert current interest rate data and mention if they're rising or falling. And don't even get me started on inflation. We all know how much that's been impacting our wallets lately. The more we understand the current market conditions, the better equipped we are to make informed decisions. But here's the thing. Past performance doesn't guarantee future results. Just because the market has behaved a certain way before doesn't mean it will follow the same pattern again. We need to understand the why behind the movements. What global events are influencing the market? What's happening with corporate earnings? These are the questions we need to be asking. Okay, so we've looked at the stock market's recent performance. Now let's zoom out and look at the bigger economic picture. Because here's the deal, the stock market doesn't exist in a vacuum. It's heavily influenced by what's happening in the overall economy. First up, let's talk inflation. The Consumer Price Index, which measures inflation, is currently sitting at insert current CPI data and mention if it's high or low. This tells us that prices are still rising, although maybe not as dramatically as before. Then we've got unemployment to consider. Right now, the unemployment rate is insert current unemployment rate data and mention if it's high or low. A low unemployment rate might seem like a good thing, right? And it is to a point. But if it gets too low, it can actually fuel inflation even more. These economic indicators are giving us mixed signals. They say history repeats itself, and when it comes to the stock market, that can be both a blessing and a curse. A blessing because we can learn from past mistakes, and a curse because, well, sometimes those mistakes lead to crashes. Remember the dot-com bubble in the late 90s? Everyone was so hyped about the internet, pouring money into tech stocks, valuations skyrocketed, and then, boom, the bubble burst. Or how about the 2008 financial crisis? Subprime mortgages, housing market collapse, banks failing, it was a mess. But even in the midst of those crashes, there were opportunities. The key takeaway here is that market crashes, while painful, are a natural part of the economic cycle. By studying past crashes, we can start to identify potential warning signs and understand how different asset classes tend to perform. Now I know what you're thinking. Graham, just tell me, is a crash coming or not? If only it were that simple. Even the experts don't have a crystal ball. But they do have years of experience, tons of data, and some pretty insightful perspectives. Some economists are waving red flags, pointing to rising interest rates and persistent inflation as signs that a recession and potentially a market downturn could be on the horizon. They argue that the Federal Reserve's attempts to combat inflation by hiking interest rates could actually slow down the economy too much, leading to a contraction. On the other hand, some analysts are more optimistic. They believe that the economy is still relatively strong, with low unemployment and healthy consumer spending. By listening to a range of expert opinions, we can get a more balanced view of the potential risks and opportunities that lie ahead. Okay, so we've established that the market can be unpredictable and that crashes, while not ideal, are a part of the economic cycle. But here's the thing, not all sectors of the economy are created equal. Some industries are considered more recession-proof than others. Think consumer staples, things like food, beverages, household goods. People still need to buy these things even when the economy takes a hit. Healthcare is another example. People get sick, need medication, and require medical attention regardless of what's happening in the stock market. On the flip side, some industries tend to be more vulnerable during economic downturns. Think discretionary spending, things like travel, luxury goods, entertainment. Understanding which sectors are more likely to weather a downturn and which ones might struggle can be incredibly valuable when it comes to making investment decisions. All right, let's get practical. Whether you're a seasoned investor or just starting out, having a solid risk management strategy is crucial, especially if you're concerned about a potential market crash. First things first, let's talk about asset allocation. This is simply a fancy way of saying how you divide your money across different asset classes, like stocks, bonds, real estate, and so on. The idea is that by diversifying your investments, you're not putting all your eggs in one basket. So, if one asset class takes a hit, the others can potentially cushion the blow. Now, the specific asset allocation that's right for you will depend on your individual risk tolerance, time horizon, and financial goals. But as a general rule of thumb, younger investors with a longer time horizon can afford to take on more risk. Remember, there's no one-size-fits-all approach to asset allocation. Chapter 7. Don't put all your eggs in one basket. The power of diversification. We just touched on asset allocation, but let's dive a little deeper into the importance of diversification. Think of it like this. Would you rather bet your entire life savings on one hand of poker or spread your bets across multiple games? Diversification is all about spreading your risk. Instead of putting all your money into one stock, one sector, or even one asset class, you're spreading it out, reducing the impact that any single investment can have on your overall portfolio. And diversification goes beyond just asset classes. You can also diversify within asset classes. For example, instead of investing in just a handful of tech stocks, you might invest in a tech ETF that tracks a broader index of technology companies. The key takeaway here is that diversification is one of the most powerful tools you have as an investor. Chapter 8. Keeping your cool: How emotions can impact your investments. Investing isn't just about numbers, it's also about psychology. Emotions like fear and greed can lead to irrational choices. When the market is up, euphoria sets in. This is known as FOMO. It can lead to buying high and overvalued assets. When the market crashes, fear takes over. Investors panic and sell at a loss. The key is to remove emotion from investing. Have a plan and stick to it. Focus on the long term and tune out the noise. Chapter 9. Finding your footing, spotting opportunities in a downturn. Okay, so we've talked about the risks of a market crash, but what about the opportunities? Because believe it or not, downturns can actually be a great time to invest if you know where to look. Think about it like this. When the market crashes, prices go down. That means you can buy assets at a discount, potentially setting yourself up for significant gains when the market eventually recovers. Of course, this is easier said than done. It takes guts to buy when everyone else is selling. But remember, the best investors are often contrarian thinkers. They see opportunity where others see fear. So, where should you look for opportunities in a downturn? One strategy is to focus on quality companies with strong fundamentals that have been unfairly punished by the market. Think of it like shopping at a sale. You're looking for bargains on high-quality items that are temporarily marked down. Chapter 10. Your game plan. Practical steps to prepare for anything. We've covered a lot of ground today, so let's bring it all together and talk about what you can do right now to prepare for potential market changes. First and foremost, assess your current financial situation. Do you have an emergency fund in place? Are you on track with your savings goals? Make sure your financial house is in order before making any major investment decisions. Next, revisit your risk tolerance. How comfortable are you with the idea of your investments losing value in the short term? Your risk tolerance will play a big role in determining your asset allocation and overall investment strategy. If you're feeling overwhelmed or unsure about how to proceed, don't hesitate to reach out to a financial advisor. A good advisor can help you create a personalized financial plan that aligns with your individual goals and risk tolerance. Outro, stay informed, stay prepared. So, what do you think? Are we headed for a market crash? Let me know your thoughts and strategies in the comments below. And hey, while you're down there, hit that like button and subscribe to the channel if you haven't already. I'm constantly putting out new videos on personal finance, investing, and building wealth, So make sure you hit that notification bell so you don't miss out. Remember, the market can be unpredictable, but by staying informed, having a plan, and making smart decisions, you can weather any storm and come out ahead.